Hello, I'm Chip Stites, and this is The Laughing Retirement. Today, along with a bit of a cold, we've got some very good information and a special announcement and an offering free that you might be interested in. So I'd like you to take a look at what we're doing and see if this might help you. So I'm going to share a screen here. And here we go. A virtual assistant and the Magnificent Seven. Solving financial problems today, tomorrow, and into the future. Let's talk first about the Magnificent Seven. What is the Magnificent Seven? Well, the Magnificent Seven is a series of 7 stocks that right now are dominating the market. It's what you hear about the most. In the S&P 500, 1.4% of the stocks make up 34% of the weight of the S&P 500. In addition to that, they are also the riskiest stocks in the S&P 500 as a group. So let's take a look at the risk. Now, we already know that the S&P 500 has a risk level of 1. So let's look at the Magnificent Seven. Well, Amazon has a risk level of 1.28. NVIDIA has a risk level of 2.12. Apple has a risk level of 1.09, Meta 1.2, Tesla 2.08, Alphabet 1, and Microsoft 1.03. Now, if you put that all together, that's an average beta of 1.4, or 40% more than the S&P as a whole. So what would I do with this information? Well, I can tell you what I've already done. First of all, I've taken profits in my portfolio, and I would sell any investment that had these stocks in them because the risk level is 40% more than the index itself. And so a disproportionate amount of the index is carrying much more risk than the S&P 500 itself. Now, most mutual funds operate on the 80-20 rule. What's the 80-20 rule? Well, very simply, the 80-20 rule is that the manager has to follow the objective with 80% of the stocks that he buys or she buys. Now, that leaves 20% more. And very often what you find is that managers will go out and get the popular stocks, the ones everybody is talking about, so that when you see your top 10 in your portfolio, you can see that your mutual fund owned those stocks that are doing so well. But that creates a problem, as well as making you feel like you've got the popular stocks that are doing well. Now, what's the problem? Well, one of the problems it creates is something called overlap. Now, overlap is when the same investments, i.e. stocks, are held in more than one ETF or more than one fund or more than one account, especially when they're the riskiest over purchase stocks and everybody owns them. Let's go back to where I first learned about overlap. This was about 30 years ago. It was in the late 90s. And excuse me, at the time, the most popular stocks were the dot-coms. And when I began reading about the dot-coms and understanding that many of them didn't have the value that the price indicated they should have, I was disturbed. Because the only thing that happens when something gets overpriced is it drops. That's what happens in the market. That's normal. We come to an inflection point where the markets are too high and they fall down. And then everybody gets upset. I lost money. I lost money. I lost money. So what did I do? Well, I sold every fund that had any of the dot-coms in it. And I went and looked at even some of my large cap value funds. And most of the dot-coms were small caps, small company stocks. And they were definitely not value. They were growth stocks. I sold them. I got rid of them. And so what happens to you is that when you are have an overlap problem. When you are looking at your funds in your, let's take 401k, for example, and you see over and over that in the top 10 are Amazon, Nvidia, Alphabet, over and over and over and over again, Meta, Tesla, over and over and over and over again. Well, you're focusing risk and you're causing yourself a future problem when the market drops, as it is going to. It creates greater losses than you would expect. Overpopular investments drop more than the other investments. So all you've done while you're skyrocketing up is create yourself a problem when the market drops down, like it always does. It always reverts to its average. So these highs are going to go back to norms and then they will start up again. So what can you do? Well, very simply, look at your ETFs or mutual funds. Look for overlap in between them, between all your ETFs, all your mutual funds. Like I said, they're guided by the 80-20 rule, which means the manager has the ability to go out and get 20% in other things. So if you have a large cap value fund that has Meta and Tesla and Google and Alphabet and Nvidia in it, maybe you don't want to have that fund. Maybe that doesn't make any sense for you. If I were you, I would consider selling them. You see, what happened in the late 90s with the dot-coms, 50% of those stocks were gone, non-existent, bankrupt, within 3 years by 2003. And then it happened again in the late, right before 2008. What did I do? Well, I went and bought things that people need every day: utilities, food, energy. And as a result, my clients didn't suffer the losses that everybody else suffered. My average client lost about 11.7% when most everybody else lost 30 to 40%. My average client had their money back in a year and a half, whereas most people took 5 years. See, Warren Buffett's rule number one is don't lose money. But most financial advisors aren't taught to change, make changes, move away from things that are overbought. They're taught that that's the manager of the mutual funds rule. And yet, when you look at what the managers of the mutual funds do, they get stuck the way everybody else does, or everybody's portfolio would never go down. So there you are. We are back to the 70s. When the Nifty 50 was popular. The Nifty 50 was 50 large company stocks that people believed were so valuable that they could not possibly lose money, and that it didn't matter what the price was, they were going to go up regardless. Well, in 1973, many of those stocks lost up to 70% of their value. So when something is overbought, there's a good chance you're going to lose money. So if I were you, I would look at the top 10 stocks in every one of the ETFs and mutual funds I own. And if I found the Magnificent Seven sitting in all of them, I would go look for things that didn't have the Magnificent Seven. Utilities, real estate, consumer staples, things that we have to use every day: food, energy, electricity, gas. That kind of makes sense right now when day after day after day, week after week after week, we keep setting new records. Now, why do people forget rule number one? Don't lose money. They invest as though the market always goes up. Financial advisors aren't taught to manage money. They are trained to sell products and invest within the risk boundaries that you established when you went to the financial advisor. You took a risk profile and you signed off on it. And as long as they stay within those boundaries, it doesn't really matter what happens. And if you're within 5 years of retirement, I would rethink my risk profile. You're not, excuse me, you're not 35 anymore. You're 60, you're 62, you're 64. And so being a little conservative just makes sense. So if you're within 5 years, maybe 7 years, maybe 10, I would change my risk profile. I would make a big deal out of spending the time to check on what I owned. Now, what did the London Financial Times say? Well, it says the valuation models show risk asset prices well above their fundamentals, raising the risk of sharp corrections. Markets appear complacent as the ground shifts. Investors and policymakers should be alert to the prospect of disorderly corrections and the potential for doom loops where the loss of confidence in, and the sustainability in government debt wax the bond market, which in turn wax risky assets priced for nirvana. This was out of the International Monetary Fund last week. This came also from the Financial Times. The Bank of England struck a similar tone, noting the risk of a sharp market correction. This from the Financial Times, October 22nd, 2025. The Opinion Equities feature, Bubble Talk is breaking out everywhere by Katie Martin. If I were you, I would pay attention. Now, what can or should you do? Well, I'm not here to tell you what to do. I am here to give you good choices and good information so that you can act on it yourself. I took profits. I took the top 25% profits off the top of my portfolio, and I put that in money market and I bought some more gold. I'm roughly 15% in gold, 20% in cash, and the remaining 65% is in low-risk stocks, preferreds, and REITs. Generally, I like value because, as Jeremy Siegel in his book Stocks for the Long Run said, over the long haul, value will equal or outperform growth with less risk. And people say this over and over again, and yet we don't listen to it. I'd like you to listen. And I'd like you to subscribe to this channel because I have something special I would like to offer you. Currently, my portfolio is less than 50% of the risk of the S&P 500. Now, what does that mean? That means that if the market goes down 30%, I'm only likely to go down 10 to 15. If I were you, I would look at the top 10 holdings of every fund I own. I would sell any fund that had the Magnificent Seven in them or any part of them. I would lower my risk. I would increase my percentage in money market or stable fund in my 401k. I would increase my holdings in gold. I would increase my foreign holdings. And then I would watch and wait. Now, if you like this short video, I am creating a biweekly newsletter with this type of financial information. I want to give you good information and then tell you what to do or what to act on. Whether or not you do it is your choice, but you'll get educated and you will begin to understand what your money is doing. Now, why do I think that's important? Well, the simple answer is I believe that you are probably your own best manager. I know the financial services industry doesn't want you to think that you can do it without them, but I'm here to tell you, investing isn't difficult. It's simple. If you use simple rules and you follow simple objectives. We will give you a simple formula for success in this newsletter. I will show you how to evaluate risk. I will show you how to evaluate your 401k. Excuse me. You will be able to ask me questions and get simple, understandable answers. If you'd like me to put my 47 years in the financial services industry to work for you, read the first 3 biweekly newsletters that are going to come out. If you want to keep on, you will be amazed at how low the price is. Less than $10 a month. Simple, easy information. You'll have access to me. You'll also be able to look at other places that will give you other information. If you decide you want to continue, we have an incredibly low price for you. If you don't want to continue, that's fine. Just stop. It's all right. No pressure here. Here, there is much value if you want to use it, to learn about your money, to learn about how to handle it. You'll find out something else too. If you're learning about your money and you're responsible for it, you're a heck of a lot less worried about what will happen to you. And that's the goal. So I want to thank you. And I want to welcome you to the Common Sense biweekly newsletter. Future topics we'll be talking about: how many investments do you need in your 401k? How do you control risk? What is a simple formula for investment success? How do you know when you're succeeding? How much should you put in your 401k and why? Where should you be saving your money? What 4 things should you look for in a stock? What does it really cost you to work with a financial advisor? All of that information is going to be in the upcoming issues of the Common Sense biweekly financial newsletter. I'm Chip Stites. This is the Laughing Retirement. And if you want a free email, free newsletter, email me below, info@thelaughingretirement, put newsletter in the subject, and we'll send it out to you. Again, I'm Chip Stites. This is the Laughing Retirement. I hope you'll join us.